Same. Let's talk a little bit about earnings and what's coming up. I guess we've got your Metas. We got a bunch of other ones later on. Anything that you're particularly going to be paying attention to or keying off of?
You know, Tyler, I think what you said to start this is the key. It's that earnings growth overall for the market, that's going to be the key arbiter of whether this bull market continues or not. And so far, I would say earnings are coming in very, very nicely. EPS is coming in ahead of expectations. Revenues are coming in ahead of expectations. And so that's all positive. Obviously, I think from a sentiment perspective, what we hear from the mega caps coming up. So we've got Meta, we've got Microsoft, we've got Alphabet this week. You've got a host of the rest of the mega caps next week. That I think is going to be very important in the short term. But overall, I think what we're seeing is that there's a broad number of companies across sectors and industries that are reporting good numbers. And to me, that supports this idea that we are seeing a broadening out of the market. We're seeing a rotation beneath the surface. And when I talk to clients, that's what I tell them to lean into. Whether or not the market's down because yields are moving higher, I think you have to be looking long term. And to me, I would be using downside opportunistically because the fundamentals are still in place, and there's plenty of good opportunities across sectors and industries right now.
An awful lot of the folks that we have on our air here, like you, these days are talking about small caps. And a lot of people have been talking about small caps for a long time. And so I guess I'm kind of from Missouri. Show me the money here. When is that going to happen? Or is it happening?
Yeah, I feel like small caps are almost turning into the international trade for the past decade of where we're saying maybe they're actually going to outperform. And we're still waiting to a large degree. But I think small caps are not a monolith. When you look at something like the Russell 2000, that's not an index I would recommend any client own on its own because there's so many companies that don't make money. And a key part of my market thesis, Tyler, is that you have to own quality. Going forward, you have to own companies that have a path to earnings or have earnings, have free cash flow. That's all really important. And when you look beneath the surface at small caps, there's a number of high quality companies that don't have significant leverage, that have strong balance sheets and can expand and are leaned into a lot of the trends that I like increasing CapEx, bringing reshoring back to the US, the artificial intelligence revolution, but being powered by data centers and the build out needed for that. So I think that's what's going to move small caps. And if we can start to get an inflection point with respect to earnings for small caps, I think that's what gets the market moving because it's so under-owned by investors right now. I think once you get a little bit of momentum, the flows will beget the flows, and you'll see some really strong upside there.
Let me make sure I heard you correctly because I'm afraid maybe I didn't. Did you say to not go with the Russell 2000 because too many of its constituents don't make money, and rather to go with small cap companies, maybe individual choices, where the profit picture is better, the balance sheets are better, the debt is lower? Did I understand?
That's exactly right. Or go with an active manager that's actively picking stocks. Right. And so you can lean into growth, you can lean into value. But owning the index overall, you've got 2,000 companies with questionable quality across maybe 750 of them.
Right. You like small caps, you say, and cyclicals, including energy, NextEra, Vertiv, and Vanek Oil Services ETF. Explain.
That's exactly right, Tyler. I think cyclicals right now have the opportunity to keep outperforming, and it's a hedge in many ways against inflation right now. So you look at the industrial complex, which is where Vertiv fits. Vertiv just crushed earnings this morning. It's been a top pick of mine for a while because they're levered to data center growth. They provide cooling systems and power management to data centers, which we know we need to invest in a lot more of them going forward. And so they're a high quality company. It was a high quality beat. They're generating more free cash flow. Balance sheet leverage is coming down. So it ticks a lot of my boxes. When you look at something like a NextEra, they pay a dividend. I think dividend growers have been underappreciated by the market overall for the better part of a year or so. And when yields do eventually come down, investors are going to need dividend growth, but NextEra has its own avenues of growth. It's the largest renewable provider of solar and wind energy in the world. They also just provided good earnings yesterday, and there's visibility to it. Their backlog's increasing. So that, again, it fits the higher quality beat, plus you get the dividend component. And energy's been a great trade. Energy hedges some of the inflation and geopolitical risks that we're facing right now. And so what I tell clients is it's tough given the gains in some of the energy names now to just pick one single stock. But oil services have been left behind relative to refiners, relative to some of the exploration and production names, Tyler. And so what I would say is buy the OIH because you'll get broad exposure to the servicers, and we need to extract more oil from the ground with less capex and using less balance sheet, and this is a name that ticks those boxes.
All right, Matt, thank you so much. Matt Orton with Raymond James. We appreciate it. See you again soon.